Let's talk about what happens next with your asset allocation decision-making. Gemma Godfrey is the head of research at Credo Capital. John Authers is still with us. We were just actually having a chat as we were listening to the tail end of Patricia's report there about whether or not we should carry on buying equities in the light of what seems to be a changing direction from the Fed. If QE3 doesn't happen, Gemma, do I buy equities?
Exactly. I mean, as we were discussing, that level of support will be taken out of the markets, but it's also a relative trade. You know, in this environment, people are searching for yield. Cash is giving you nothing. That huge trade in fixed income has obviously narrowed, with yields on investment grade having narrowed about 65% now. So, relatively speaking, if you're looking on a risk-return basis, there will still be people rushing into the equity markets. People are chasing the rallies, and a lot of money is still waiting on the sidelines.
Do you agree, John?
I'm not calling for a great crash or anything like that, even though we've all recently lived through one of those. Plainly, it's a big moment of truth when the Fed has to work its way out of this situation at some point. The ECB looks as though it's not, ready to start doing so, and it's now softening us up for not just one rate rise but a few in a row. And again, it's a relative thing. Up until now, we've had this very impressive relief rally. World stocks have doubled in 2 years, but part of that has just been whenever you're having an argument, it gets short-circuited by, well, what else are you going to buy? Yeah. And that becomes much harder to do when, over history. The 6 months before the beginning of a tightening cycle tends to be a bad time to be entering stocks.
But also, even if the Fed doesn't induce another round of QE, inflation is still going to continue to go up, isn't it, for the next year? I mean, aren't we still dealing with kind of that impact?
And stocks arguably have some role as an inflation hedge. Yeah. You probably want to look for the ones where you're most comfortable about their cash flows coming in, and you might be prepared to pay up for true inflation hedges. And maybe if we are really worried about inflation, even if rates are going up, then yet again there's that much more interest in commodities.
And also, I think it's more a case of, instead of calling when to go into equities and when to leave equities, it's about getting smarter on how you invest within equities. So whether the markets, however high the markets rally or fall, there'll be a starker divergence between sectors and also between stocks. And we are starting to see that. And if you look at the rally that we've seen so far, it has been driven by high beta, low quality names. For example, if you look at the consumer discretionary stocks, I mean, within the US, it's even more stark. I mean, since the bottom, consumer discretionary has outperformed staples by 50%. And within Europe, we've seen a 15% outperformance since the middle of last year. And really, in an environment where people are worried about their jobs, people are worried about, as you said, inflation, there are so many different concerns out there. And as we saw from the profit warning on Dixon's, people are going to be reining back on their luxury spend.
Luxury spend or super? It's interesting. LVMH is going to be out with the trading update tomorrow. LVMH has massively outperformed, and the whole sector continues to do so as it consolidates. Dixon's is, you might need a new flat screen telly. LVMH is true upper end. Even within that discretionary area, do I need to differentiate what I'm looking at? Yeah, and actually that's a very good point. It's about differentiating even within that, because there is consumer discretion, there is ultra luxury, and also it depends on where they're gaining their sales from. So LVMH, I think they have sold. They've had greater sales in their airports in China than they have in their home market of France. So you are seeing, despite the queues around the block on the Champs-Elysees. Exactly.
So you are seeing, it depends on where they're getting their sales from, where they're positioned, what market they're in, etc.
Gemma, before we let you go, is there a particular area in Europe where you see more value at the moment?
Oh, I mean, there's a lot of cause for concern, and there's a lot of areas that I'm slightly wary of. And as I said, I mean, instead of making a call specifically on a sector, I would use contagion, as we heard, from the worries about Portugal, etc. I'd use times of stress, when people are very worried about the markets, Europe as a whole, to go in and actually use that as a buying opportunity. And when we're looking at different sectors, I think, because of all the trouble that we've seen in Japan, there are a lot of tech companies that are especially going to be quite hard hit, because March is usually quite a high month for them as well. So I think instead of making a call like that, I would say focus on strong balance sheets, much more protected demand for their products.
Gemma, thank you very much. Pleasure having you in the studio today. Gemma Godfrey from Credo Capital.
Keep the emails coming. Plus, after the break, who lives in a house like this?